How to select an IRA. An IRA, or individual retirement account, is a special type of savings and investment account designed to help people prepare for retirement. All IRAs offer a tax advantage. While some types of IRAs allow the saver to defer tax on the money added to the account, other types allow the saver to take tax-free payouts from the account. The term IRA refers to the purpose of the account and its tax status, but not its contents. The assets within an IRA can be a variety of things: CDs, stocks, bonds, ETFs, mutual funds, and more, so there's more to opening an IRA than deciding which type you should open. In addition to deciding which type of IRA is right for you, you also need to decide what types of assets you want in it, which will in large part be influenced by where you open it. Method 1: Choosing where to get an IRA. 1. Remember, an IRA isn't a one-size-fits-all proposition. Just because a friend or family member of yours likes their IRA doesn't mean it's the right IRA for you. Many IRAs have real advantages for certain types of customers that don't apply to all customers. Consider your situation and do your research before you make a commitment. Although there are many variables to consider, one big variable is age. Older savers will generally want to transition into more conservative investment, saving strategies, while younger ones will be able to be more aggressive. The reason is simple: time. If a younger person loses their money, they have time to try and make it back, and can therefore afford to take more risk. An older person doesn't have that same luxury, so they need to be more conservative with their money. 2. Open an IRA with a bank if security is your biggest priority. If you open an IRA with a bank, you'll most likely open the IRA as a CD, or certificate of deposit. A CD is a financial instrument functioning like an interest-bearing account. You purchase a CD from the bank, agree not to touch any of the money for an agreed-upon amount of time, and once the term of deposit is finished, you can cash in your CD with a very moderate return. The drawback of a CD is the rate of return. The interest on a CD is typically just a little higher than the interest on a savings account, and nearly any other kind of investment will provide you a higher rate of return. Therefore, a saver in their 20s or 30s can probably forego a CD as a primary retirement account as a consequence. On the other hand, the deposit in a CD is FDIC insured. That means the amount of your deposit is guaranteed by the U.S. government, even in the event of a bank failure. No other type of investment has such a guarantee. Therefore, it would be wise for a retired person or an imminently retiring one to transfer at least some of their retirement savings into a CD. That way, there's a guaranteed reserve. 3. Use a traditional brokerage for the most flexibility. Opening an IRA through a brokerage, like TD Ameritrade or Scottrade, will enable you to operate your IRA with the most flexibility. You can put a mix of stocks, bonds, ETFs, or mutual funds in an IRA you open through a brokerage. Nonetheless, brokerages often charge higher fees than other types of IRAs, so the flexibility needs to be something you'll actually use to make it worth it. An ETF, exchange-traded fund, is a lot like an index mutual fund, except it is sold on the stock market itself, like a share of Walmart or IBM. So one ETF might be tied to an index, like the Dow, but instead of buying into a mutual fund, which would invest portions of your money in what it considers to be stocks representative of the Dow, the ETF invests in the index as a whole. The ETF itself is bought and sold on the exchange, and rises and falls in value throughout the day, as opposed to a mutual fund, which has a value calculated at the end of the trading day. While many ETFs are tied to an index, they can be tied to virtually anything, like real estate, currency, or bonds. If you open your IRA through a brokerage, you can invest in mutual funds and ETFs from any company. In contrast, IRAs purchased directly from mutual funds only offer a limited selection. Since you can put stocks and bonds into a brokerage-run IRA, you can customize your portfolio to an extent not possible with other sellers. Therefore, IRAs with brokerages are probably better for active investors, wealthier investors, and investors with more sophisticated financial knowledge, who all tend to be mid to late career professionals. 4. Go with a mutual fund for a middle-of-the-road approach. Opening an IRA with a mutual fund is probably the best way to go if you are a less active, long-term investor. They have many of the same advantages as an ETF, such as being able to track a large swathe of companies instead of just one, without some of the drawbacks, such as trading fees, a fee for each time you buy or sell something within the IRA. While many mutual funds have minimum required investments, usually between $500 and $3,000 to open an account with the fund, there are some that don't. Betterment, for example, is a robo-fund managed by computer algorithm and not a human, that has no account minimum. Just keep in mind that nothing is free. Many times, the lower the minimum, the higher the associated fees. Mutual funds are typically best for investors who are learning about the market or investors who don't have the time or inclination to actively buy and sell on a regular basis. That describes a lot of investors, which explains the popularity of the mutual fund. Method 2: Deciding what type of IRA to open. 1. Open a Roth IRA first. There are a number of reasons why it's best for most people to open a Roth IRA before they open a conventional IRA. While both Roth and conventional IRAs are meant to help save for retirement, there are some key differences. For example, with a conventional IRA, pre-tax income is contributed to the plan, meaning you pay taxes on the distributions when you retire. With a Roth IRA, you contribute after-tax income to the plan, but your post-retirement distributions are tax-free. Since most people who are opening an IRA will see their incomes climb as they get older, their tax burdens will rise. People who make over $132,000 or $194,000 for couples aren't eligible to contribute to Roth IRAs at all. Very few young people make more than $132,000 per year, but people's incomes usually rise over the course of their lifetimes, and many young people will make that much eventually. Therefore, it makes sense to take advantage of the Roth IRA first. Conventional IRAs have an MRD, or minimum required distribution, that a person must collect at age 70 and a half. Roth IRAs have no MRD, and the distributions are untaxed. 2. Open a traditional IRA if you've already opened a Roth IRA. When you've already opened a Roth IRA, and you're maxing out the yearly contribution, open a conventional IRA. Conventional IRAs are ideal for those who expect their tax burdens to decline by the time they receive their MRD, those who make too much money to contribute to a Roth IRA, or those who already have a Roth IRA and already max it out each year. For both Roth and conventional IRAs, the contribution limit per year is between $5,500 and $6,500. If you've contributed more than the allowed amount, the excess will be taxed at an added 6%. The contribution limit is the total contribution limit, and not the contribution limit for each IRA. So if you had two IRAs and you funded them equally, you could only contribute $2,750 to each. 3. Consider a SEP IRA if you are self-employed. The third major kind of IRA is a simplified employee pension, SEP IRA, which is an IRA for the self-employed. SEP IRAs are advantageous for two reasons. The contribution limits are much higher than the typical contribution limits, up to $53,000, and the contributions are tax-deductible. You can also contribute to your employees' IRAs under an SEP under the same terms. However, most small business owners seem to prefer the SIMPLE IRA for employee contributions. The SIMPLE IRA allows matching contributions up to $12,000, and is easier to add employees to.